this is Tracey Brock from Real 101, and I'm happy to introduce Irwin Boris from Heritage Capital Management. Hi, Irwin. How are you today?
I'm great. Thank you for having me today.
You're very welcome. It's good to have you. So Irwin is a master of all. He's had 30 years in the real estate industry in all walks of life as far as real estate is concerned. Irwin, maybe you can elaborate a little bit that for me.
No, my pleasure. I went to school, have an undergraduate degree in accounting, took the CPA exam, and my real intro to the real estate world was being an auditor. Really checking the numbers, making sure that we could substantiate the expenses and producing audited financial statements and tax returns. And I wasn't crazy, but back then everything wasn't automated. It was actually, I'm sure everybody's seen that ugly accounting paper that's like yay wide with 15 columns on it, and you had to get the numbers of the boxes, and it just wasn't for me. And so my first real segue into commercial real estate was to work for a very large owner operator who was also a client of the firms at the time. And they taught me the property management side of the business. They stuck me in a 20 building, 5,000 unit complex. I had direct responsibility for 4 buildings and 1,000 apartments. And I had to deal with in New York, some of the buildings have union staff. I had
Oh,
to try to go collect rent in landlord-tenant court, and you got to see how some of these people were, sort of knew the system, and they could be there 8, 9 months or more and not pay rent.
oh,
Uh, and how to deal with the federal and state agencies, whether it was Section 8 or senior housing or other assistance programs. Um, so from there, I've either been at work for owner managers, doing asset management, property management, acquisitions, and then I've also been a lender, starting with Apple Bank for Savings, which is a bank that was taken private by a real estate developer, and they really honed my credit skills on the underwriting side. And then 10 years with General Motors, had a GMAC commercial mortgage, their finance arm, and then with another Freddie Mac seller servicer, a Dust lender, a Bellwether Enterprise who does a lot of tax credit deals on affordable housing. Uh, so I've worked in everybody's shoes, and I'd like to think I've seen it all, but there's something new you learn every day in this business.
I do agree with that. That's an extensive background, though, but you're right. Every day there's something new, especially in the industry of financing mortgages and just investing in general. So, yeah, you're right. So, I just wanted to start by asking you, what's the status of the real estate investor market right now?
Well, I think it's sort of in some ways a bit of a hiatus. People are looking at valuations and where interest rates are. Now, at the Federal Reserve, moving, the benchmark, I don't know, 500 basis points. For a while, as rates moved, it had no effect on cap rates, on purchase prices. But as people realized they could not finance because there was no debt service coverage and they needed to come with like 60 or 70% equity, it sort of put a halt on everything. And if you look at some of the operating expenses, when the reinsurers pull out because of all the natural disasters that you've had, whether it's storm or in the West Coast with all the snow they had up in the mountains last year, people couldn't get out of their homes, and in other parts of the world, your insurance costs for an apartment owner went in some markets from $300 per apartment to $1,100. And if you have a big
Wow.
building where you have 300 or 400 apartments in it, it can be devastating to your cash flow, especially if you had too much debt. Now, historically, you could borrow 75 or 80%, whether it was Freddie Mac or Fannie Mae or CMBS or things like that. And so when you're that highly leveraged and you don't have enough rainy day money and the operating expenses grow a lot faster than your income, you got a problem.
Yeah.
Um, so I think it is the opportune time for someone who actually has cash to come into the market now. I look at this as the great basis reset opportunity for the next 2 years. But I think that unfortunately, some individual investors and some institutions are going to take some pain.
Yeah. Yeah. I think that's kind of across the table for sure. So, can you eat the internal rate of return, the IRR?
No, you can't eat the IRR.
Oh,
And I think that a lot of investors are attracted to the marketing from some of the sponsors, syndicators on multifamily and other deals, saying, look, I'm going to take your money and it's going to be a 2.5x, 25 IRR. I'm going to give you back 2.5 times your money. And it's all based on pro forma. And a lot of these, syndicators, you go to their websites and you look at them and how young they are. A lot of these guys were at best in college in 2008, 2009. And so they really haven't seen the cycles repeat or even a full cycle of ups and downs. And so as prices went up on the cost to buy these buildings to, institute their programs, uh, they became a little more creative on their, Excel modeling. And then I think part of also why people are in trouble is investors. If you invested in 2010 and again in 2012 and then again in 2014 and 2018, you made money hand over fist. You figured, oh, this is great. Lightning's never going to strike. And you, as the investor, probably got a little bit lazy also and did no due diligence of your own in the last couple of years.
Yeah.
But in our business, I was taught that if I can't underwrite on this, if I can't get that to work on a napkin, don't buy it. And that's how I think investors should have focused on what is the distributable cash flow every year. How much could I expect to get in year one? Because if you're getting 8 or 9% in the first year and rents are growing, we do pretty much commercial, it's all industrial, and rents do grow at 3.5 or 4% a year per lease. That's the contractual rents. If that's the case, then you will get to a 17 or an 18 or even a 20 IRR without even thinking about it.
Hmm.
And if you're really looking to create wealth for yourself, which is why a lot of people do invest in real estate, and a lot of people have made vast fortunes in real estate. The cash flow pays for the luxuries, especially if you're a W-2 salaried employee, where the appreciation that from eventually happens from the sale of the asset really creates your wealth. And I think just people were just chasing unicorns.
Gotcha. Where do you see opportunities coming for the passive investor?
I think there are a lot of good opportunities now. We're seeing more opportunities than I can capitalize. And so this is actually the first year we'll be out fundraising with high net worths and accredited investors, because I think there's a lot of smaller owners that are just tired of the cycle, and they realize they should have sold 2.5 or 3 years ago, but they own the property for very little, and they just either want to retire or they want to do something else, or they don't want to deal with the ups and downs of the market. And so there are a lot of investment opportunities at very high cap rates. So even if you were an individual investor and you wanted to buy a small industrial building, a commercial building in the right location, you had 3 tenants, you could find some of these for under $1 million. You have to figure out how to manage it, but we're seeing so many opportunities where in a perfect world, if I had $500 million, I'd buy everything at a 9% return and I'd wait to finance when the Federal Reserve dropped the rates. But there are opportunities. Multifamily, I think, is going to take a little longer. There's 50 to 70 billion dollars of loan maturities this year and next year.
Yeah.
That will probably not be able to refinance their current mortgage balances. I think the banks are just sort of trying to hold on. They don't want to write down mortgages. They'd rather try to work with the borrower rather than it hits their reserves on their balance sheet. So some of those may work themselves out. Some of them may not work themselves out. But I think it's going to take at least 15 to 18 months for you really to see a lot of opportunities on the multifamily side.
It's on my understanding that's about 83% of renewals are coming up in the next 3 years. So
Yeah.
it's going to be a really interesting landscape out there for investors and for just people trying to keep it all together as well. So
No, it is. And again, if it's an older loan, that's a three, it might be at a lower loan to value, and therefore they could probably refinance their maturing debt. If it's a more highly leveraged property that was bought at a higher end of the cycle with a bridge loan, they have more of a problem.
yeah, for sure. What should investors look for when screening sponsors or syndicators?
I think they should look at transparency. You're going to ask for their track record, full cycle deals. And I think even before that, what you do is you take the sponsor and the sponsor's name, or the principals and the name of the firm that they're working under, and you put them in the search bar of Google. And, whatever it is, real estate company A, and, put plus troubled loans or loans of default and see what comes up.
Yeah, the magic
You
of
know,
Google.
and you Google, and because everybody, even some of the the institutionals, I mean, you hear about Brookfield giving back office buildings in San Francisco.
Yeah,
And it could be a $300 million loan on there, and they're just walking away from the money. Then the little guy or the syndicator that's got 10,000 or 12,000 units has got to have some problems too. And so really do some research. You'll find out how many loans they might have that are on watch list, how many loans are in default. Uh, you might also put in investor relations issues because sometimes when the deals don't go as planned, sponsors go dark. They don't communicate.
mhm,
Um, People have asked me to help them make decisions on whether they should answer a capital call or not. And some of the emails that they've gotten from investor relations are just hard to believe, where the sponsors knew fair well what they were doing by not taking a full term interest rate cap. And they blame everybody from, a lunar eclipse to Jerome Powell. It's his
yeah,
fault the deal's not working out,
yeah,
to the Chinese supply train, and why, it's costing more to renovate an apartment. Because as the prices went up, they became a lot more creative. And if you really go back, you'll see that expenses probably grew at 1 or 2% in the model, and revenue grew at 10%, and it was the other way around.
yeah.
So you really and even if it's a sponsor that you can't find a lot about, or you just see they have troubled loans, and if you get to the investor relations person and just ask them about that, if they're not transparent or you feel like they're holding back, I would just disconnect from that sponsor.
Okay, okay. So with these deal sponsors, how do they have deals in default and they're still raising new?
Yeah, that's a good question. Some of these sponsors are raising like a preferred equity fund. And I think the preferred equity is really going to be targeted at their other deals that are underwater because no sponsor wants to have a default on his record. It's going to keep him from being able to borrow and continue growing his business. So if I had 20 loans that were I couldn't refinance because I couldn't afford the interest rate caps, or I needed some rescue capital for capital improvements, and my investors are not willing to invest additional fresh capital, I'm going to get preferred equity, which will be senior to the existing equity, and save the deal because I got to save my own name as the
Gotcha.
sponsor. And there's not a lot of transparency with things like that. And then if you look at the institutional players, all the funds, they've all raised massive amounts of preferred equity for this rescue capital because they know it's going to be needed.
Well, how will asset management be going forward?
I think, asset management is very hands-on. It's about, for us on the commercial side, we're looking at whose lease expires 12 months out. Do they have a renewal provision? Do they have to notify me 9 months in advance of expiration? Because in 8 months and 29 days, I'm going to start having a broker walk through there with a new tenant. And either you'll wake up and realize that, hey, what am I doing? Or you'll be out 9 months from now. I think it's about controlling costs to the best of your ability. It's about trying to anticipate what could happen. At this point in the cycle, I think it's safe to assume, although you might have 1 or 2 people that disagree with me, that the interest rate hikes are over. At least I'd like to think that
I
they're
like to
over.
think that too. I have a strong feeling that they have to be.
No, I'm saying I think they have to be. And from listening to Jerome Powell the last couple of times, they want to cut rates. They're looking for the data. But I think they're done because at this point, if they raised rates more, they don't want us to, the capital markets to just disintegrate and create any kind of recessionary condition. So I think that we're pretty safe that they're done. It's about, when will insurance costs come down? And I think that will take another year or two, depending on property tape. But again, there's a shortage of employees, especially in multifamily. It's like who manages the asset, the A team, the B team. And because you can't continually raise rents, you have to try to manage your payroll costs.
Mhm.
What's the best bang for the buck? And me as the investor, I'm sort of oblivious to that. I have no transparency on what the quality of the management is, but the sponsor the general partner should at least have the expertise to know when he's got to step in and really manage the property or manage the property management company's people.
Mm.
Uh, and some of them have never held a brick. Some of them don't know what it is to paint the wall or fix a doorknob, and that's really a problem. They've relied all on third-party contractors.
That can become cost prohibitive if,
Yeah.
yeah,
Think about
for
it like
sure.
as a homeowner, how much can you do around the house yourself versus how much you have to outsource? And how many bids do you get? And do you know if they're doing the right job? And you had stuff done in your own home that you're not happy with, and you got to call somebody else.
Yeah. Are they showing
So
up?
are they showing up? So magnify that 250 times if it's a big building.
Yeah. Yeah. Well, I think the biggest question would be, how should investors make a decision on choosing, what deal to invest in?
I think for us, and I invested in not only my own deals and with some other people I know, is I'm looking at cash flow because I like the cash flow. I know if the deal doesn't work out, and I know there are contractual rents. I mean, if it doesn't work out, I mean, there's no big profit at the end. And I went into a deal and I got, for example, 8% a year for 7 or 10 years, and I got my money back. That would be okay too, if that was a bad deal. The first rule, at least my first rule, is never lose money. So the question is, how am I not going to lose money? And I'm not going to lose money by making sure it's a deal that's always going to be able to have distributable income every year. So I'm not buying a vacant building on a plan that says we're going to lease it up. I'm not buying a building, for example, on a 4% cap rate and financing at 7 or 8, because you have a lot of climbing to do to get out of that hole. So
Mm.
I think they really need to focus in the next couple of years, definitely on cash flow, because cash flow is great. If God forbid you have a speed bump in your personal life, maybe you're laid off temporarily, maybe your side hustle doesn't work some months, or you have some crazy luxury item you want to buy for yourself or treat yourself. That's what the cash flow is for. So the cash flow, will pay for the luxuries or help you compound and invest in other deals where the appreciation of the asset will really create long-term wealth.
Okay, that's good advice. That's good advice. Well, Irwin, thank you so much for coming. Irwin Boris from Heritage Capital Management. We really appreciate you participating with our podcast. So thank you very much. You can
No, my
reach
pleasure. Happy to share my experiences, and that's why I have no hair anymore. It's being in the trenches for so long.
honestly, I think that's why my hair's coming thing out too.
That does that from stress, your hair starts to fall out.
Yeah. Well, I appreciate you coming on and thank you very much. You can follow Irwin on all his socials, LinkedIn. Please remember to follow Real 101 at all our socials. You can reach me, Tracey Brock, at Dominion Lending Centers, at tbrock@dominionlending.ca. Thank you again and have a wonderful weekend.